Asset markets are a useful gauge in judging the mood of a nation. The trouble now is that they're telling us different stories. US Treasuries, seen as one of the safest investments out there, are performing very well, and commodities, seen as one of the riskiest, are performing poorly and priced for a long slowdown. But equity and credit markets, on the other hand, are priced for a V-shaped economic recovery. So who's right? Let's first look at equity markets. Most equity markets have retraced 50% of their early year losses. Consensus expects corporate earnings in the States to drop 20% this year and bounce back 25% next year. We think that's too optimistic, and here's two reasons why we think equities will struggle. Point number one, ING looks for a 7% decline in US GDP this year compared to the consensus of 4%. Point number two, the rally in US equities means that earnings yield look too low given the lack of corporate guidance. Either earnings expectations have to improve or valuations have to cheapen, and we think the former is unlikely right now. In credit markets, our credit strategy team believe credit spreads might have narrowed enough for the time being. They point to the high yield space, which looks priced for a mild dot-com style level of defaults in the region of 7%. But given the size of the slowdown our macro team is predicting, 10% default rates seem more likely. And the story from FX markets is, watch out. The safe haven yen is the only currency stronger against the dollar on a year-to-date basis. Our view is that FX markets are right to show caution. We still think it's too early to be looking for value in some of those battered emerging market currencies. But for those looking to express recovery stories, currencies like the Australian dollar and the Swedish krona, backed by strong sovereign balance sheets, may hold up better than most.